Hi, I'm Steve Chater with TCT Property Management Services, and we are the resource for people building financial security with real estate. And what I thought we should talk about today is how to actually build wealth faster, right? And most of us are interested in having that financial independence. Many people call it retirement, but we call it financial independence. Why? Because you can achieve it far sooner with real estate, far sooner than 60 or 65, which is what most people think. So, we define wealthy as financially independent. In other words, I have enough money coming in to support my lifestyle, enough money coming in to support my lifestyle without having to go to work for it. And that's called passive income. So the question is, if you're an investor, do you have to sell your assets in order to create the cash you need? So for example, if you own a stock, you could own millions of dollars worth of stock, but if it's not creating enough cash flow for you to support your lifestyle, you have to sell it. And when you sell it, then you don't have any more stock. Or the other question is, do your assets create the cash that you need to support your lifestyle? Another, again, passive income. Real estate provides that passive income, not only growth like equities and stocks, but passive income from positive cash flow. So here's some thoughts. Can I save my way to financial security? True or false? Can I save enough to be financially secure? Here's another thought. Cash is not an asset. Cash is a tool to buy assets, to acquire assets. It's a medium of exchange. And you give me the cash and I give you an asset that creates cash flow for you. If I buy an asset, how much does it make? What is the return on investment? Most people don't even know what the ROI is on their 401k. And so that's one of the issues, right? And then cash flow. How much do I need or how much do I actually want? So here's a couple of assumptions, and I'm going to go through this quickly. You can review it again if you want to, but let's assume inflation's only 3%. We know it's 3 times that right now, but let's also assume that your expenses are $5,000 a month. And if you took your calculator and you turned it sideways, you'd be able to actually follow this example with me. And you would take 1.03, and there's a button on your calculator on your phone that with the Y over X, and you put in 30 years. Why? Because I'm going to retire in 30 years, let's say. You come up with a factor, 2.42. You take that 2.42 and you multiply that times the $5,000 a month, your current lifestyle, and it comes up with 12,136. That's how much you're going to need to just maintain, not to be better, but to maintain your current, because that's what inflation is going to do over the next 30 years. So if we take that and multiply it times 12, that's $145,000 of annual expenses. And so if you took 145,000, a financial planner would tell you, just take 4%. And you'll be able to preserve your money because your money should be able to grow and you should be able to live off of 4% per year, right? And so in order to be able to get 4% or $145,000, you would need to have saved $3.6 million over this next 30 years. No problem, right? Well, there are 360 months in 30 years. 360 months. So all that means is you have to save $10,000 a month for the next 30 years. Not easy to do when you're only making $5,000. Okay. So what's going to happen with inflation? Well, if inflation goes in at 7%, like I'm showing right here, we're going to need $11 million, not $3.6 million. So how are we going to get there? Well, if I invest in stocks and we say, okay, my target is have $3.6 million. And let's say I'm starting with $75,000 and it's in the account and I can get a rate of return of 10%, because some people will tell you if you just hold on to your money in the stock market, that's what you're going to get. And in addition to that, I'm going to make a contribution of $2,000 every month just to grow and build that. So $2,000 a month, start with 75. I'm going to add another 2,000 a month. And so how long will it take? Well, in 26 years, I will have reached my time. Okay, that's great. That's less than 30 years. And so, by the way, I would have made a total contribution. My cash going in would be $622,000. Now, here's the deal. When you talk about stocks, a dollar of stock costs you $1. You have to pay a buck to get a buck's worth. So as we said, we're going to start with $75,000. We're going to invest $2,000 a month. We're going to get 10% interest on it. We hit our goal in 26 years, and you've contributed now $622,000, but you got $3.6 million. That's our goal. That's what we wanted to do. Well, could we do it another way? I'm going to show you a faster way to get there, and that's called playing Monopoly for real. We're going to start with the same $75,000. We're going to buy one house that's worth $300,000. We're going to take $60,000 of our money, and we're going to put it down, and we're going to borrow at 4% interest. You should have at least a $250 a month positive cash flow. Could be more, but at least a $250,000 a month positive cash flow. That's an extra $3,000 a year of the tenant's money that you could use to pay down your loan. Okay. If you did that, the loan pays off in 20 years, not 30, but the loan pays off in 20 years. Now, when we wrote the book called Hold on Investing in Real Estate, we went back for 40 years and we looked and we said, you know what? We found the average appreciation of real estate over the long term was 4% appreciation per year. Now, we've been going way faster than that now. However, let's just be conservative at 4% per year. Okay, so what does that look like? Well, 20 years from now, I would have a house that's worth $540,000. It's free and clear. I got a $500,000 house, and now my rent is $42,000 per year, or $3,500 a month. When? 20 years from now. Why? Because inflation's at 3% and the rents are going up. So rents have been increasing at 35. So we're partway there. Now, what if I waited 30 years and used the same example? My house now is worth almost $1 million. It's worth $973,000, and my rent on that one house that I bought now is $4,800 a month. Well, how much do I need? Well, remember, we needed $12,000 a month. So with one house, I'm almost halfway there. Okay, so when you look at it this way, you buy a property and somebody else pays for it and it continues to grow. Well, what if you did that more than once? What if you said we just keep going faster? And what if you did that and you say, I'm just going to use the tenant's money to build my equity? So here's our original loan. Remember, we bought it for $300,000. We put $60,000 down. So I've got a $240,000 loan for 30 years at 4%. And I'm going to take that additional $250,000 and I'm going to put it on there. What happens is my loan's paid off in 21.3 years. Okay. What if I just raise the rent $75 somewhere down the line there? All of a sudden, my property is free and clear in less than 17 years. And who's paying for it? The tenant's paying for it. What are we talking about? In the other example, you're taking your money and you're putting it in and you're letting your money grow, which is awesome. We're talking about getting there faster. So you stay in the game. We started with $75,000. We bought this with $60,000 down. That means I still have $15,000 saved over here. And if I take my $2,000 a month, remember I was adding that to the stock market? Well, we'll put it in savings for 2 years. Now I've got $64,000 and it's saved up and I can buy it again. If I repeat this four times over a 6 to 10 year period, if you look up here, I will have created $14,000 in passive income. How much did I need? I needed 12. I needed $12,000 in 30 years, but now I'm 10 years sooner here. How much have I contributed? $60,000 for each $300,000 house. Times 4 is $240,000 over say a 10-year period of time. That's what I put in. And if you remember in our other example, we contributed $622,000 in order to get through it. So you see what's happening? Less money, I'm getting there faster, and I'm achieving the goal of what I'm looking for. A number of years ago, the U.S. Commerce Department did a study of the American population. And in that study, they said, wealthy people. Well, what does wealthy mean? They said financially independent. What does that mean? It means they did not need their pension and they did not need Social Security in order to maintain their lifestyle. They had passive income coming from somewhere other than a pension and Social Security. Well, here's what it looked like. people at age 65, which people think that's retirement age. I'm older than that now. 6% will qualify. 6 people out of 100 will actually qualify to be financially independent. And out of those 6 people out of 100, 5 of them said it was real estate that got me to that financial independence. Want to get there faster? Just play Monopoly. It's like we did before. So our thoughts were, can you save enough money? Yeah, you could save if you could put away $2,000 a month, put it in the stock market. Remember, cash is not an asset. Cash is a tool to acquire the asset. So if we save up some cash and acquire an asset that somebody else will pay for us, how awesome is that? And then, you know what's interesting is that we play Monopoly as kids and we know the game. Why did we stop? Why did we not play it for real? The people who did got to financial independence. 5 out of 6 said we did it with real estate. So, hey, we're TCT. We're more than property management. We provide the education for investors to make the right decisions. We provide the information they need to understand and know what's going on in the market. And of course, we do property management too. So thank you for listening. I appreciate you watching this video. I want you to see you build your financial independence faster.